After being stagnant for a few years, the local cement industry is set for a shake-up with the entrance of Sephaku to the market. At the same time, one of the country's dominant players, PPC, is expanding into Africa and has plans to build a $200 million plant in Zimbabwe. Stanlib owns PPC in both its balanced and industrial funds, and Warren Dick interviewed analyst Anashrin Pillay earlier to tell us why.
Anashrin, thanks for joining us on Investment 360 this evening. You're the industrials analyst at Stanlib, and we wanted to talk today a little bit about the cement industry. Just a couple of things going on. Before we get to PPC though, I wanted you to give us a brief introduction or explanation of what exactly is happening in the industry, especially considering that we're seeing a new entrant coming to market in the form of Sephaku.
Okay, so at the moment, I mean, the industry is probably running at about 12 million tons. Just to give you some sense, it's about 70% of at utilization. So the market's probably around 17 million ton market. And yeah, so that's currently where we are. We estimate growth for the last year. Obviously, the Cement and Concrete Institute puts out quarterly numbers which are in retrospect at the moment. So we would estimate that the growth rate for last year was about 4 to 5%. So that takes us to around 12 million tons. And yeah, so with Sephaku coming to the market, they're expecting to bring on 1.2 million tons, which is roughly about 10% of the market, and they're expected to come online on the 18th of November. That's according to their website anyway. So at the end of this year, they should be producing some cement.
Just in terms of Sephaku, obviously we know it's a new entrant. We know Dangote from Nigeria is involved with the business. Who are the other shareholders, and how have they chosen to enter the market? Have they come by an acquisition, or are they actually building capacity themselves at this point?
Okay, so basically they owned in part or as an associate by the listed company Sephaku, who has other assets obviously, and then Dangote owns a share in the listed entity. They're basically having gotten funding. They're basically building a greenfields plant, which is the first plant since I think the 1930s odd. So it's the first plant for a long time in South Africa, and they're building it in the northwest province. So it's about, as I said, 1.2 million ton plant, and then further on they're building a 1.4 million ton grinding facility in Mpumalanga. So I would think at some stage they would get up to the 2 million ton mark in terms of getting cement into the market. So that's kind of how they've arranged, the arrangement is made. So Dangote is obviously the big backer in this new greenfield cement plant.
Just in terms of the technology, we've seen in other industries like the steel industry, new arrivals bringing new technology into the field. What sort of efficiency gains is this new plant expected to have versus some of the rivals who have the older factories, the older cement plants?
Yes, definitely. They would obviously use newer technology. It's a Chinese plant, so it's a turnkey plant, which is basically they come in and just build the whole thing for you. And it would be more efficient than some of the existing plants, like some of PPC's older plants. It would probably be equivalent to a dual boom, which PPC has in their stable, so a similar kind of efficiency. And you obviously would be able to gain some efficiency. So that would kind of, in terms of financials, would help their operating margin a little bit. So they would probably get more of efficiency through that, and obviously lower costs and lower input costs by using less energy intensive materials.
In terms of cement itself, it's a fairly commoditized product. So do you think that the arrival of Sephaku is going to affect capacity at any of the other competitors at this stage?
Just our initial thinking, it's quite hard to determine. As I said, it's the first entrant for a long time, but we would think that they would take market share away from basically all the players. Just to give you some sense of market shares, I mean, just on our calculations, we calculate PPC to have a market share between 30 and 35%. And then the second player would be Afrisam, which would have anywhere between 25 and 30%. And then we have Lafarge, which is in third place, the big French cement maker. And then NPC has around about a 10% market share. That kind of gives you a sense of what the market looks like.
Okay, so all around it's going to be Sephaku should eat into some of that market share.
Yes, but just to clarify a little bit, they would initially supply into the inland cement market, which is quite competitive, and basically all the competitors are there. So they would give up some. I would think that the competitors would give up some market share. Yes.
Now, your preferred pick for the cement industry has been PPC. It's a stock that you own in both your balanced and industrial portfolios. Just take us through the case for PPC at this point in terms of First of all, its ability to deliver cement into the South African market, and then we can talk about a little bit about the African expansion.
Okay, so from that perspective, I mean, we like PPC because it's kind of entrenched in the local market, so it is the largest player. And the local market's probably going to chug along a little bit, probably tracking GDP for the next couple of years, unless we have a big infrastructure rollout, which it probably benefit from. It also has a strong retail footprint as well, so it also gives you exposure to that market, and social grants obviously been supporting that market, albeit slowing. And then also, I mean, basically PPC is, in terms of Africa, I mean, they're looking to ramp that up, so they're currently sitting at about 20% revenue from Africa. They're hoping to get that to greater than 40% by 2016, and that's basically by making small investments into. So at the moment they've got operations in Zim and Mozambique and Botswana, but I think that what will happen is eventually, I mean, they've already made small acquisitions in Rwanda and Ethiopia, and they're planning to build another 1 million ton plant in the north of Zim, in Harare, to supply into the Tet province. So there's plans afoot to actually do these things, and also they do have the financial capability to actually roll out these things. So their plans are basically incremental, which we think is a good way to go, and it gives us the exposure we need in terms of infrastructure spend. Also, I mean, even at the bottom of the cycle in South Africa, they're still doing 25% operating margins, which is nothing to be sniffed at. And coupled on top of all of that, they're still delivering a 4% dividend yield. So from that perspective, it kind of ticks the boxes in terms of early cycle infrastructure play that's fairly stable.
So would you say that they're actually the first company that's moving into Africa in quite a serious way? Are they even doing that via, as you say, bolt-on or very small acquisitions in different regions?
Yeah, I wouldn't say they're the first, and probably they're a little bit belated in it, but the way they've gone about it, by taking equity stakes and getting the IDC involved and etc., they've gone about it the right way by doing it incrementally, because Africa, I mean, as we all know, it's not a one country kind of place, and they have been existing facilities. I mean, they've been in Zimbabwe for the last 100 years, so it's not, for them, it's expanding there is not a new thing. They've entered the Ethiopian market and the Rwandan market. I mean, basically, their thinking is high GDP plus combined with good population. So Ethiopia, for example, is going to grow at roughly 7%, plus it's got a population of about 85 million people. So it's going to need cement, basically.
Just in terms of the very interesting one was the investment that's going into Zimbabwe at this point. I think the company was planning to spend $200 million US on expanding the plant there. Are they facing the same challenges as some of the mining companies in Zimbabwe around indigenization and making sure that they've got the right shareholding for this business? I
think they've been quite clever in actually sorting that out first. So they basically split the business up into the local portion and the international portion, and basically changed the name from Pretoria Portland Cement to PPC. And then they managed to get the indigenization certificate now recently by conducting a BEE deal, and obviously they're also listed there, which also helps. So they managed to tick those boxes as well. So they waited to get the indigenization certificate first, giving part ownership away, and thereafter managing to kind of try and get this finalization of this other deal going.
Now, the last time I checked that the Zimbabwean economy was not performing very well. So what is the thinking behind putting the plant, or expanding the plant in Harare rather? Is there a cost advantage by doing that there? You mentioned Tet province, but you know, do they have access to the resources there in Zimbabwe already, or is it just a case of expanding on the current operation so that they can supply Tet, which is not too far away from Harare?
I think the thinking was quite clever. So basically they managed to secure, obviously you need the mining rights or the limestone to actually build a cement plant, but also it's basically, Tet is kind of shielded from the coast. So you get higher cement prices there, and it's quite close to supply into there. So it's quite a strategic benefit of actually putting a plant there. And they have knowledge and expertise about the Zimbabwean market as well. So they could also supply in there as well if they needed to. So in terms of strategic positioning, I think it's quite a smart move on their part.
In terms of the broader African expansion that they've got at this point, you've mentioned Kenya, you mentioned Ethiopia. What is the kind of demand that you've seen on the continent for concrete at this point?
So just to give you some sense, I mean, over the last 10 years, so 10-year compound annual growth rate in West Africa and East Africa has been above 10%. compared to South Africa or Southern Africa, which has been at 3%. So the demand has been there, and they actually reach periods where they run out of cement. So it's actually the demand and the population growth, I think, will come. So there will be demand for cement. It's just the competitive landscape is quite competitive. I mean, the internationals are in there, the Lafarges, the Holcim's, the Heidelbergs, they're all in there as well. So as I said, PPC has been quite surprising to the market, I think, that they've been managed to actually secure facilities at quite good rates and not paying up for them, and actually incrementally growing their value, which I think has been probably the right strategy.
Now, just in terms of the funding this expansion program, is this putting stress on the balance sheet at this stage?
Okay, I think with Trifosa coming in, which obviously having quite a good financial background, and also Ketso now also having a financial background, I think they've been quite savvy in cleaning up the balance sheet. So basically the debt is basically ring fenced around the BE deal, so it's not actual debt, it's probably notional debt. So the actual gearing and the facilities they have could be quite substantial to actually to carry out these expansions, and they're not really spending as much as they could locally, because they don't need to. They're not running out of capacity. So they've been quite savvy in actually scaling back on their expansion in the Western Cape, etc., to actually make some facilities available for actually funding these African expansions.
Now, you've obviously said that you've held this share in the portfolios for some time. I'm sure we have a few retail investors out there that would be keen to know whether you still think the share offers upside and value at this point.
Yeah, I think it's obviously run relatively hard. I think at this point we're still overweight, but we're not actively purchasing at this stage. But I mean, if there's a pullback, and obviously with, as I said, I mean, I don't think the African kind of, unlike some of the other stocks, I don't think the African incremental value has really been captured by the market. So I think that could be quite an uplift to them if they get it right. And I mean, there's little things like the STC will drop off this year and things like that, and historically PPC has been a great dividend player. So I mean, it's one that you could accumulate over time, I think, rather than having a big bang approach.
In terms of the picks, one last question before you go. How's the construction industry looking? It's obviously downstream from the cement industry. Yeah. Any signs of activity there? I
think there are some green shoots. I mean, you're seeing with the last reporting season now, I mean, with Wilson Bailey and Group 5 reporting, they've reported a recovery in earnings. And I think that's going to be a trend for the rest of the companies as well, where you see that earnings have bottomed and things are getting incrementally better. And usually the market likes a recovery story. So, I mean, there are green shoots here and there. And notwithstanding, there may not be an immediate increase in infrastructure rollout, but I mean, just returning to a decent level of profitability, there will be some incremental change in the share prices.